Robo-advisors are automated investment platforms that use algorithms to manage and optimize your portfolio based on your financial goals, risk tolerance, and time horizon. To maximize returns using robo-advisors, it's essential to start by clearly defining your investment objectives, whether it's saving for retirement, a major purchase, or building wealth over time. Choose a robo-advisor that aligns with your goals, offers low fees, and provides features like tax loss harvesting, automatic rebalancing, and access to human advisors when needed. Diversification is a key strategy implemented by robo-advisors to reduce risk and enhance long-term return. These platforms typically invest in a broad range of assets including domestic and international stocks, bonds, and sometimes alternative assets. By consistently contributing to your account, even with small amounts, you can take advantage of dollar-cost averaging, which helps reduce the impact of market volatility. It's also wise to periodically review your portfolio's performance and make adjustments if your goals or risk profile changes. Many robo-advisors offer goal tracking and financial planning tools that can help you stay disciplined and focused. Additionally, leveraging features like automatic dividend reinvestment and setting up recurring deposits can accelerate portfolio growth. Staying invested for the long term and avoiding emotional reactions to short-term market movements are crucial to maximizing return. In summary, using robo-advisors effectively means combining their algorithmic strengths with disciplined investing habits, strategic goal setting, and regular monitoring to build wealth efficiently over time.